So welcome everyone. We'll get started in a second here. All right. So welcome everybody and thanks for tuning in today. So we will be talking about financial advisors and specifically the questions you should be asking them and even whether you have to even bother getting one and you know which advisor is right for you basically. All right. There we go. I think I'm done with that. There's no feedback. Well, all set. All right. So without further ado, let's get started. So what's the role of a financial advisor? Before you can figure out exactly what are the key questions you should be asking your financial advisor, and before coming up with the actual the questions and to figure out whether the one financial advisor is right for you. First of all, what is the role, right? Because let's figure out the role before we figure out if it's a right match for us, right? Well, the role of a financial, and by the way, this is not just a play on words, because I know depending on which province you're in, depending on which jurisdiction you're in, sometimes here the word advisor is spelled with an E, like ER. Okay, so sometimes the word advisor with an E instead of an O, that one is protected by law, meaning that you need certain credentials to be an advisor with an E, but the word advisor with an O is not protected in some jurisdictions. Others, it's the reverse. In other cases, both are protected or both are not protected. So again, this is not just a little play on words. So for the purposes of today's session, whenever I'm saying advisor with an O, it really encompasses someone who's supposedly in in a position to actually provide said financial advice legally, from a legal point of view. Right? So what is their goal? Well, their goal is really to create and to update a financial plan that is right for you. So the key word there is not just create it once and forget it type of thing, but really update it on an ongoing basis and making sure that basically whatever information that you're getting is right for your own purposes. There are many investments out there. A lot of them might be right for certain people. Many others might be the wrong thing for certain people. So the same investment that might be right for me might be terrible for you and might be so-so for somebody else. So all depends on how much risk we're willing to tolerate, depends on where we are in our lives, how secure is our job. Are you making a living because you're a tenure track professor and pretty much you're only going to get fired in a very rare cases, or are you someone who has 3 part-time jobs and keeping their fingers crossed that they're not going to be fired tomorrow or that the industry is not going to go belly up, for example. So it really depends from one person to another. So in this case, what is a financial plan? What am I talking about when I'm saying financial plan specifically? Now, all of the links that I'm going to show you right now, that I'm clicking on the links, when you see them here, if you just scroll down in the video description, you already have all these links uploaded for you to use at your own leisure. All right. So specifically here, when I'm talking about a financial plan, I use this definition of a financial plan when it comes to financial planning. So basically, an advisor, whichever way you want to spell that word, it would be someone who is licensed and able, in an ideal world, to give you the proper advice depending on where you are in your life cycle, right? Are you about to graduate university and just starting off your very first job? Have you been working for X number of years and right now you're in the process of going through your family building and career building years? Or are you pre-retirement? So are you in your late 50s or early 60s and about to retire in the next 5 to 10 years? Or are you an octogenarian and you're in your 80s or maybe even early 90s and have been retired for the last 20, 30 years or so? So every single one of those individuals will need different amounts of assistance, different amounts of help, and as well as even the same amount of help, different investments will be right and wrong for those individuals. And advisors, again, a lot of times people think that the role of an advisor is merely to tell you, well, this is a type of investment that is right for you. I mean, to some extent, yes, but that's really only about 5-10% of their job. The rest of it is really to structure the investments around you, around how you change over time, short-term, medium-term, and long-term. How do your goals get altered and changed long-term, right? So at each one of these steps, you will need different resources. And by the way, I've used this website on previous occasions. If this is the first video or live stream that you're watching, again, I know it doesn't seem like an official website, Get Smarter About Money. That doesn't scream to you as official government website. I realize that, but it is actually maintained and updated by the Ontario Securities Commission. So in Canada, unlike the US, where the SEC, the Securities Exchange Commission, regulates all of the US stock market, in Canada, every province has their own regulator. Now, obviously, because Toronto is by far Canada's largest stock market, there's another one also obviously in Montreal, Vancouver, and a few other cities have tiny ones that are mostly online. So all of the other smaller ones are under their respective jurisdiction of whatever province they're in. But obviously the main stock market, the Toronto Stock Exchange, as well as the Toronto Venture Exchange, which is kind of higher risk startup stocks that are on the Venture Exchange, those are regulated by the Ontario Securities Commission. So that when you have a website that is literally made and maintained by the regulator of securities in Canada, for sure that your information is going to be unbiased and valid. And as a matter of fact, there's literally no ads whatsoever on this website because, again, it's a government website, despite the fact that it might not look like it. And again, that's your first link in the description of this video. All right. So again, a good advisor will look at go through an evaluation process with you. It's called a Know Your Client form. So they'll be asking you a certain number of questions when you're first meeting with them. Virtually, in the vast majority of cases, the first meeting is free of charge and doesn't involve any obligation on your part. So from your perspective, you're literally conducting an interview the same way that but you're the interviewer, not the interviewee. They're the ones being interviewed by you, because you have to make sure that that particular advisor offers the services that you actually are looking for and that are actually right for you. Again, if you're someone that has $10 million to invest, you would be most likely looking for a very different type of services than if you're someone who has $1,000 to invest. And in certain cases, it doesn't make much sense to get a licensed advisor, just because their fees would far outweigh the extra benefit that they would give you. Right? So again, there's pros and cons, and we will be discussing this over the next 45 minutes or so. All right. So today's session is actually relatively short. So that's that. So basically, a good advisor. So we'll ask you these questions. So you're asking them questions to find out about them and see if there's a good fit, and they should also be asking you questions to figure out how they can best help you, and if they can actually help you, and if the products that they're licensed to sell actually match the products that will be right for you. Again, there's probably around 60 to 80 different certifications that you can get. Some of them are to get one of those certifications, you might require a 3-year bachelor's degree. 2 to 3 year bachelor's degree, plus then you might also require an additional anywhere from 2 to 5 years worth of work experience before you get some of those designations, plus exams and tests and so on and so forth. Plus you have to pass a certain number of ethics courses and be approved by the ethics board of your specific institution or financial institution you work for. So for some of them, the only way to attain some of those higher level certifications is to go through all of that. And for others, to get the basic certification to be allowed to sell basically just your standard mutual fund is usually an undergrad in any field and then a roughly 2-week to 1-month course online. So that's for the basic certification. And in some cases, you can, if you're a bit older, you might even be able to skip the undergrad pre-requirements altogether in any field, right? I'm not trying to say that the person that only has 2 weeks worth of experience knows a lot less than the person who has 3 years worth of theoretical experience and 2 to 5 years worth of practical experience. But I mean, you be your own, you draw your own conclusions, right? Would you rather go see a doctor that actually went through medical school, or someone who followed a 2-week online seminar on how to be a GP, right? I'm not saying that the 2-week seminar doesn't give you any information, but right. So again, some of the good ones will assess this as well as while they're also answering your own questions. The great ones will not only assess your current situation, but also ask you future-leaning questions. When do you plan on having a family, if at all? When do you plan on buying a house? What do you plan on doing during your retirement? Even if you're in your early 20s, it's never too early to start thinking ahead. It doesn't mean you're not allowed to change your mind. By all means, you're allowed to change your mind. But this is why, again, a good advisor won't only provide you with a financial plan to begin with, but will also be updating it on an ongoing basis with you, right? So does everyone need an advisor? No, again, not everyone needs an advisor. For instance, when would you not need an advisor? Well, typically speaking, if you have less than $100,000 to invest, right? So if you have less than $100,000 to invest, then you probably would be perfectly fine going with other alternatives. The other alternatives that would be ideal for you in those cases would most likely, for most people, be to go with some form of robo-advisor. So a robo-advisor such as, Wealthsimple, Nest Wealth. There's a whole bunch of them out there. And I'll cover some of these, and I'll review some of these in future videos. And once I start making those 10 to 15 minute videos in July or August. So that way, depending on which one you're interested in, you can just look at those reviews. So if you have less than that, this is probably your best bet for most people. Right? Another alternative would be to generate or set up your own balanced diversified portfolio. And if you weren't here for any of my previous sessions, again, we discussed the balanced diversified portfolio bit. So that's your standard 60-40 portfolio. And I know, again, this is a bit of redundancy if you've seen these before, but it's again, people do not realize how ridiculously simple it is to just set up a decently balanced portfolio. You don't need, it's not rocket science. And yes, a good advisor will determine whether 60-40 is right for you, or whether 80-20 is a better split for you, because you might be younger and more and might be okay with higher risk. But again, they would ask you a number of questions to assess which type of portfolio is right for you. Again, and we've covered this in the past. So watch some of my previous videos about this, about how to balance a portfolio if you haven't seen them yet. Anyway, so a balanced portfolio will be 20-20, the standard old-fashioned one. There you go, and like this. Okay, so these are percentages. All right, the first number illustrates how much you would be investing in stocks, not individual stocks, but general diversified ETFs ideally, or low-cost mutual funds if you cannot find an ETF, but ideally ETFs. And this would be your income in the form of bonds and PF, so preferred PF shares, so preferred shares. Okay. So this is your growth. So those are stocks. And then income, that would be bonds and preferred shares. And here, if you're in Canada, right? So if you're in Canada, this would be 20% Canada. If you're in a different country, whatever your country of origin or you're currently living in is, that will be the 20%. Then 20% US, 20% international stocks. The only exception to that rule is if you're in the US. At that point, what you would want is to divide this up into roughly half. So half of it should be in the US and half of it to all other countries international. So if you're in the US, that would be 30% US, 30% international. Okay, but that's the only time this would apply. And then in that international would obviously include Canada. If you're in Canada, it's 20% Canada, 20% US, 20% international. If you're in France, it would be 20% France, 20% US, 20% international. The story goes on and on and on. All right. And why this breakdown? Again, I've covered this in previous sessions, so watch those videos. Now, 20 to 25%, these would be government bonds, and then 15 to 20%, depending on which one of those percentages you're taking out. So this one or that way, all right, that would be in preferred shares. All right, so there you go. That's your basic balanced diversified portfolio. That is probably one of the most basic portfolios that will probably outperform most other things for the vast majority of people. Now, it's not right for absolutely every person in every single situation, but you could do much, 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 much worse than a balanced diversified portfolio roughly in line with these things, okay? All right, so people think that that's what an advisor does. Yes, that's again 5% of their job. And then they're making sure that as you're getting older, the percentages are still fitting with what you're actually looking for in terms of, are you looking at maintaining, gaining wealth? Are you looking at not losing money, et cetera, et cetera, et cetera. So basically, if you have less than $100,000, just going with a robo-advisor is probably more than enough. Or you can go with the slightly more complex version of doing the balancing yourself. When does an advisor become essential, even though you might know how to balance a portfolio of ETFs? Because obviously the advisor will always charge you more, because the underlying ETFs, you can get a pretty decent balanced and diversified portfolio for roughly, and we've seen this in the past, for roughly 0.25%. That could be that would be your fee. Whereas most robo-advisors will probably charge you between about 0.6 to about 0.8% or thereabouts. Okay, so obviously that's quite a bit more than this, but this 0.6 to 0.8 typically includes that 0.25 of management fee of the underlying investments that you're actually using or that you're invested in. All right. So in those cases, so you might say, well, why would it be worth it ever paying more? Well, you have to look at what it is that they're providing you with. If you don't have the time or energy or knowledge to do this yourself, then that's a small price to pay. This difference here is a small price to pay to get those advantages. When does it start making sense to switch to something else, to a licensed professional instead of just going with the robo-advisor ones? Well, it would start making sense again once you have more than $100,000 in most cases. And most good advisors will charge you just right around 1%. If you're really lucky, that 1% will include the underlying MER of of whatever ETFs that they're using to do the investing for you. If not, that the MER might be on top of that. But again, ideally try to find one where the 1% covers this. Now, the good news is going with a fee-based advisor that basically charges you a certain percentage of all your assets under management, or an hourly rate. In both cases, you can actually deduct that fee. Basically, you can deduct the fee from taxes. So it's a tax deductible fee. So that's pretty nice in the grand scheme of things. So in real terms, you actually end up paying less than that. And the higher your tax bracket, the less you end up paying in real terms, because since it's tax deductible, let's say you spend $10,000 in advisor fees per year. Obviously, this starts making sense. This would be if it's a 1% fee and you have $1 million under management, then the fees would be $10,000 in a year, right? And at that point in time, if you have $1 million under management, let's also assume that you're in one of the higher income brackets in Canada. Just for simplicity's sake, let's say you're in the 50 or 49% tax bracket. So if you're in the 49% tax bracket, then invariably you're literally only paying, because again, 49% of this would be a tax refund, a tax write-off. So you're indirectly only basically paying $5,100 in fee, right? So your indirect fee is actually 0.51% if you think about it that way, okay? If you're going just with a standard mutual fund or ETF that you manage yourself, that fee is not tax deductible, all right? So that's another thing. So when does it become essential to get an advisor? Is once you have more than $100,000 and once you start needing additional services. So a lot of advisors will not only be able to tell you which investment is right for you when, but also provide you with resources if you're looking at buying an investment property, or if you're looking at buying things in the exempt market, for example, once you have a couple of $1 million, for instance. Because for the exempt market, you need about $1 to $2 million of assets. Whereas if you just want to deal with a basic advisor, you can start at around 100,000. Most usually require at least $250,000 under management to take on you as to take you on as a client. All right. So in previous sessions, we talked about how I told you, depending on which study you're looking at, between 70 and 95% of all investors, including professionals, fail to beat the market averages, right? So if you're just going with the standard well-diversified market index ETF, 70 to 95% of investors, including professionals, fail to beat those market averages. So how can you make sure you get an advisor that can beat the average? How can you get one of those 5% or whatever small minority of advisors that beats the market? Well, the answer to that question is it's actually the wrong question. You're not asking the right question. The goal of getting an advisor, the primary goal of it, is not to get an advisor that will beat the market averages. Why? Because most advisors will tell you that they'll do their best to beat the market averages, but they cannot guarantee it. Usually, right? You'll have something along the lines of, past returns do not guarantee future. Past results do not guarantee future returns, basically, or something along those lines, right? They love to say that because legally speaking, they have to tell you that they cannot promise future gains. So the question shouldn't be, can this advisor beat the market averages? It typically should be, what services do they provide? Are the services that they provide me with the right ones given my current financial situation, right? And again, people tend to chase after returns. They tend to try to find that advisor that promises them, or that borderline promises them that they can somehow beat all the market, or do something that no one else has ever thought of doing, and yes, there are some advisors that can do that, but consistently advisors that can do that consistently are incredibly rare. So statistically speaking, you're setting yourself up for failure if that's the main reason you get an advisor. The main reason you should get an advisor is to look at legal ways to either defer or eliminate taxes, lower your fees as much as possible, and the fees that you do end up having to pay your advisor, make sure that they are as much as possible, again, legally tax deductible. So it's basically, yes, you're paying for a service, but make sure the service is tailored to you, and make sure they're managing your risk. They're looking at, they're considering all the things that many people don't really think about when they're looking at investing. And they're enabling you to basically make informed decisions. That will help you save a lot more money and invest a lot more money and become a lot more wealthy than trying to find the one advisor that claims to beat all others out there. I guarantee you that there are some excellent advisors out there, and some of them are actually good at beating the market semi-consistently. Even they don't beat it 100% of the time. But for every single one of the ones that is able to beat the market semi-consistently, there are literally thousands of them that fail to beat the market. And in some cases, they are so terrible that they're actually trailing the market by many multiple percentage points. So you might be trailing the market by 20% every year, or 15% every year, which is ridiculous once you factor in the fees and etc. All right, so it's not the question, can my advisor beat the market? The answer is most likely not, because the vast majority of them can't do it consistently. But it should be what types of what type of services do they provide? Are those services right for me? And how can they help me legally lower or eliminate my taxes, as well as lower the fees that I'm paying? Okay, you'll be much better off with that. So here are a few things to look out for when you're evaluating advisors. Were you promised high returns on a low risk investment? If you ever hear an advisor telling you, "Oh, I have this, I have this investment right here, incredibly low risk, and it's going to, double your money in X number of," walk away and ideally report them. It's illegal for most advisors, most licensed advisors, people that are actually registered and licensed, to make those sorts of claims. The only ones that can unfortunately make those sorts of claims, professionals that can make those claims in the sort of the broader financial industry, not the main financial industry, are typically realtors. So there are some punitive measures for realtors that overpromise things that are not realistic, in terms of, just buy this condo and, it's going to double your money by next year, or some ridiculous thing like that. There are some, in certain cases, depending on what designation they have for realtors, there might be some punitive measures. But typically there's very few. When it comes to financial advisors, not specifically looking at real estate, financial advisors, there are a lot more rules and regulations around what they can promise and what they can and cannot promise, right? So it's not really, again, in most countries, it's not allowed, or it's not, advisor, I cannot make outlandish claims like, promising you 20% returns guaranteed. There's no such thing, right? Unless you're dealing with a country that has very, very high inflation, and you can get a 20% guaranteed rate of return by just keeping money in a checking account. But at the same time, the money devalues a lot faster than what you're getting in return, right? Anyway, so remember, typically speaking, the higher the promised returns are, the higher the risk. So if you ever hear an advisor promising you high returns with low to no risk, it's either that it's something illegal, or it's the advisor is misrepresenting the investment, or they're inept and don't know what they're talking about. Okay, so walk away if you hear an advisor like that, and ideally report them to the various regulatory agencies, because that is a punishable offense. They should not be doing that. They're not supposed to be doing that. Did you also have enough time to make a decision if you got cold called by an advisor? By the way, never answer or never start talking to an advisor that just cold calls you. Okay, that's usually. I know this is kind of I sort of going against advisors, that because there are still some that will do cold calls. The problem is these days it's incredibly difficult to tell by just calling, or by talking to someone on the phone, whether they're actually a real advisor or they're just impersonating a real one. So as a result, with so many scams going on these days, I would recommend, if an advisor ever cold calls you, don't give any personal information via that initial phone call. Instead, ask them what is their extension at whatever financial institution they're working with. Make sure you find out the phone number of that financial institution, not the one that they're giving you, but actually find out the phone number of that financial institution, and go through that financial institution to find the extension, to figure out whether it's a real thing. Because many people have been scammed by pretend financial advisors that actually end up not even being financial advisors or licensed. Okay, so typically, in most cases, if you are the one going to contacting a financial institution or investment branch of a bank or something like that, telling them I'm looking for an advisor, then obviously at that point you're sure that the person you're going to be talking to will be someone that is certified, and the vast majority of them will not give you any of these weird time constrained options to be like, you have to make a decision. There's this, time limited, investment that, you have until tomorrow. Otherwise, if you don't invest now or never type of thing, right? So that will typically not happen if you're dealing with large companies and contact them directly. Might happen sometimes over the phone if you're cold called. Again, stay away from those things. Were you also given some form of confidential or quote unquote inside information or insider information about, this new hot investment? Now, keep in mind, trading on insider information is illegal in most jurisdictions and most certainly is illegal in Canada. So again, if someone is trying to tell you, oh, look, invest with me because I have all this insider information, number one, it's illegal for them to share that information, and it's illegal to them to entice people to invest with them, right? So stay away. Can you verify the investment with a credible source? So if they're going to tell you about a slightly more unique investment, which might not necessarily be based on insider information and might not be time limited, but can you verify that investment with other sources? Again, if you're contacting one of the large banks, one of the large financial institutions, it's unlikely they're going to start, the advisor will start, talking to you about some random thing. But there are smaller investment outfits out there, and some of them might literally be a 1 or 2 person operation. And in those cases, you might not necessarily know whether the advisor you're talking to has the right qualifications, has the right, what are their incentives really for offering that investment. So make sure to double check investments with other credible sources if you're ever in doubt. And also, is this person and is the company they're working for registered? Is both the person and the company they're working for registered with the security regulators? And again, this would be the second link in the description of today's video. So if you just click there, here's basically the arethéregistered.ca is run by the Canadian Securities Administrators. So again, that's one of the industry regulators here. So all you have to do if you want to figure out if someone is registered is to go to this website, click on the link here to check now, and then you literally enter that person's credentials. So are you looking for a firm, or are you looking for an individual to figure out if that person is registered? So you can just click next. And here I'm just going to use, so Garth Turner, if you don't know him, he basically has a personal finance blog, which I highly recommend, greaterfool.ca. He focuses primarily on real estate, but discusses balanced portfolios and many other things like that as well. He used to be in politics. He's been in politics for, I think, about 10 years or thereabouts. He actually was briefly was the minister responsible for the Canada Revenue Agency under Stephen Harper. So, and right now he's a licensed advisor, as you can see here, okay? So obviously, figure out who the person is and whether they are actually licensed, whatever advisor you're talking to. All right. So here you go. So that's incredibly important. And furthermore, from the same, so this is your third link, also from the Securities Administrators organization here, you basically have this 3-page document, which is a checklist. All right, that you can use, and I encourage you to bring this. So, and by the way, whenever you're looking for an advisor, as I said, you are the one interviewing them for a position because they're your employee, right? The only way they're going to make money is to have you as a client, right? They're working for you, okay? So the same way that you would go through an interview process to hire a new employee, you should also go through an interview process when you're hiring a new advisor or your first advisor. Don't just take the first one to come along. Ideally find, references, but you can also do all of this on your own, right? So do a bit of legwork. So this is literally a 3-page checklist of key questions to ask and things to look for when you're looking at advisors. So again, keep in mind, this is the industry association that keeps track of all licensed advisors, whichever way you want to spell the term advisor, and with any of the 60 plus designations across all of the Canadian territories and provinces. Okay. So this is not me trying to tell you, be extra cautious. No. Literally the industry regulator and the industry association is telling you this is what you should be doing when you're shopping around for an advisor. And I would highly advise that this is exactly what you're doing when you're shopping around for an advisor. If the advisor feels offended or starts being like, well, why are you asking me all these questions? That's a good sign that that's probably not the right advisor for you, right? Because if someone's good at what they're doing, they shouldn't feel threatened when someone's evaluating their answers and they're just, writing things down, right? So yeah, you basically make sure to always ask, first step here, check if they're registered. Are they registered themselves? Is the company registered? Is their registration active? Just because they used to be an advisor and they were registered 20 years ago, but since have been doing whale photography or what have you, it doesn't necessarily mean that person is still in good standing with the regulator or the agency, right? Check if there's been any disciplinary history. Again, this you can typically go to the IIROC website. So here, search for disciplinary cases. You can do this, just going to this website here. I haven't included that link in the video description because you have the link, the third link in the video description of this live stream is literally this. So you can just follow the links within this once you open it up. And depending on which designation they have, for some of them you might have, they might only be licensed to sell mutual funds, and if they're working for a company that is part of the MFDA, then this is where you would find that. Otherwise, check the IIROC. That there's disciplinary cases, a subsection of their website for that. And then again, if you're in Quebec, then you want to also check this one, la Chambre de la Sécurité Financière website, and look at ethics and discipline to find out, right? So you don't have to do this in front of them, right? But basically bring the first page with you and maybe, or like have this with you. You can maybe just ask them to see if they mention anything. But yeah, you don't have to be Googling this live while you're in front of them. Now, here's a checklist of various questions to ask. Some of these I have summarized on my next slide. Others are more detailed here. So again, make sure to look at this, okay, and review this. And these are very, very important, okay? Questions to ask. There we go. So there we go. So what are the actual questions to ask a potential advisor? So I think it's very clear by now. The first thing, or one of the first things that should be coming out of your mouth is, are you registered? Is the company you're working for registered with the relevant authorities, right? And why do you want them to be registered? Well, because if they're registered, then it ensures that they're working within a certain margin of the allowable and recommended ethics guidelines, and that they have at least the bare minimum of skill when it comes to that. And also, it's perfectly appropriate, and you should, as a matter of fact, ask them about their background. What is their background? How are they just starting out as an advisor? For how long have they been practicing? Do they have, literally, are they a finance major, or did they just switch into this recently? Not trying to say you always have to find a person that has 30 years worth of experience, but again, different people are different, have different priorities. So if the only way that you will feel comfortable and sleep soundly at night is to have your advisor, the person managing or your life savings or a good chunk thereof, be someone who has X number of credentials, X number of years of experience, then make sure you get an advisor that fits that. Otherwise, why would you give your money to someone that you're not comfortable allowing them to manage said investments for you, right? So, and who's the right person, right fit, depends from one person to another. The same way that, ask 10 people and they might tell you, about their favorite food, and they might give you 10 very different answers. Same thing with financial advisors. It's also appropriate to ask them how they're getting paid. Are they getting paid primarily by commission? Are they getting paid by salary? Is there a mix of both? Do they charge an hourly fee, an hourly rate? And I mentioned earlier, the higher end advisors, a lot of times they'll be charging you a flat fee and that's 1% management expense ratio is literally 1% of all the assets under management. So if you have $1 million, that's 1% per year. Whether the market goes up, whether the market goes down, it's always 1% of all the money that they're managing for you. Okay, if 1% happens to be that fee, if the fee is higher or lower, obviously you adjust that fee. Others won't, they'll have a small MER of the underlying ETFs, for example, of 0.25 or thereabouts. They personally won't charge you a percentage fee, but they will charge you an hourly rate. So for every hour, they might charge you anywhere from about $200 to about $1,000. Tends to be usually the going rate, depending on province, depending on the services you're looking for. Obviously, the more services you want, typically the higher the fee. But it's not necessarily always that the highest fee advisors are always better or always offer more services. Okay. What kind of products and services do they offer? Are they licensed to offer? As I said, different products and services require different additional certifications. So for some of them, they might only have the certification to sell you mutual funds, and they can only sell you mutual funds for the financial institution they're working for, and that's it, right? Some advisors might also have certifications to sell you life insurance products. Some might be able to also manage your portfolio, whereas others are only licensed to literally advertise and talk to you about mutual funds and try to find a portfolio made up of those mutual funds that is right for you. Okay, so figure out what it is that you're looking for, and that the advisor you're looking at or considering hiring is actually someone who's likely to be able to help you out, with your short, medium, and long-term investment goals. And it's also fine to ask them who are their clients. If you're a retiree, you probably want to, you're probably better served going with an advisor that is specializing in people that are more, retired. You don't have to, absolutely. It's just that the more clients that this advisor has that is similar to you, the more likely it is that they've experienced, those same clients might have experienced different, similar, they might have similar goals as you have, even if their individual situations might be somewhat different, right? So it's fine to ask them about the clients. Obviously, you don't have to ask them about specific names of clients, but so who do you typically work with? Do you typically work with people that have $1 million plus or in investment assets? Are you typically working? Do you also provide tax advice, et cetera, et cetera, et cetera? And also, key question is, how will you help me to reach my goals, right? They're working for you. How will they be helping you, right? Are they going to try to manage your investment, lower your taxes legally? Are they going to try to guess the market or time the market, which typically doesn't work? And as I say, when you hear someone that is, basically if you have an advisor that is like, oh, we're going to actively manage your investments, chances are, once you factor in the higher fees that are invariably associated with active management, in the vast majority of cases, I would say about 95% of the time, you're pretty much guaranteed to not match the market return. Okay. And then what level and frequency of interaction and of service can you expect from the advisor, right? So what level of service? Again, is it just you sending an email or maybe give them a phone call for 20 minutes once a year? Or are you doing quarterly checkups for an hour, 15 minutes, or whatever, right? So find something that is okay with you. And same thing, if you're getting an advisor and they're making it very clear, okay, I'm only charging you this much, but it also means that I'm only going to be in touch with you twice a year. If that's fine with you, then that's maybe okay. If you need an advisor that on an ongoing basis reviews your financial plan, every 6 months, that's probably a bit overkill, but who knows? Different things happen to different people at different points in their lives. It might be that person might be the right person. So again, who is the right advisor for it might be very different for person X versus person Y. That being said, in all instances, you want an advisor that is knowledgeable enough to be able to explain the products and fees being charged. If you ever see a little bit of uncertainty on their part, watch out. Okay, and the last or before last link that I've included in the description is this report that was done by the OSC in collaboration with a number of the regulators. So you see, it's 5 years old, but it's still quite relevant. So you can see here actually. It was done. It was a collaboration between the Ontario Securities Commission, the Investment Industry Regulatory Organization of Canada, and the Mutual Fund Dealers Association of Canada. right? So these three are basically industry regulators, and they regulate different aspects. So the IROC is basically a national self-regulatory organization which oversees all investment dealers and trading activity on debt and equity marketplaces in Canada. OSC, again, they administer and enforce compliance with the provisions of the Securities Act in Ontario. And then the Mutual Fund Dealers Association is recognized as a self-regulatory organization for mutual fund dealers, for basically institutions that sell mutual funds, right? So these are the three main regulators, right? And then the other one that I mentioned earlier, the Association of Accredited Dealers, or again, I forget, the CSA is their acronym. Those basically, they regulate the designations, okay? So, now, obviously, this is a 96-page report, and most people won't ever bother reading that much. What I would recommend is just look at the executive summary. The executive summary is about 3 pages long, so I would highly advise that you skim, at the very least, the executive summary. Skim through the executive summary in those three odd pages or thereabouts, all right? And they're basically, what they did is they specifically looked at Ontario, and they sent... They sent undercover reporters or undercover agents pretending to be people that wanted to open an investment account with an advisor and getting an advisor, and they basically literally did an undercover investigation about what type of information, the quality of information provided, et cetera, et cetera, et cetera. And again, you have the full detailed report here, and some of these findings aren't great in terms of, yes, there are some excellent advisors out there, but there are also some really, really bad ones out there that probably should not be licensed, or at least should probably, take a few week refresher course before advising individuals further, okay? So again, there's many graphs and charts and whatnot in here. I'll just point this one out, which is sort of an overarching summary chart. So they looked at 83 different shops. Again, that's their term for it, not mine. Again, they're financial institutions. They refer to them as shops, and the people specifically dealing with mutual funds and advisors in general, they call them salespeople in this case. So you understand what the industry and what the regulators refer to each other as, makes you really understand what the primary focus is in terms of when it is to provide you with a service for many of these, okay? So let's look at some of the good news. The products and services offered were discussed in 78% of the time, whereas 20% of the time, roughly, the products and services offered were not disclosed. So you'd think that that's the basic thing, right? You're telling someone, okay, sure, invest. I'll be able to manage your investments. But still, 20%, I mean, I'm glad that 78% of the time they mentioned what they're about to invest in. But it's a bit troubling that 20%, that's 1 out of 5, didn't bother telling the prospective client what they're going to be investing their money in, right? It's the equivalent of saying, well, I want to go buy furniture, right? And I'm looking for, let's say, a new stove and a new table. And you're going to a store, and the store tells you, yes, we sell furniture, and you're like, well, what type of furniture? Oh, we'll talk about that later. But yes, we sell furniture. Please, come over here and buy things from us, right? So it's very odd if you think about it in that context, right? That should be the first thing mentioned usually, right? Or at least without you having to ask questions, because obviously if you ask, they have to tell you. But this is basically, they went in there and just looked at what these advisors would volunteer without being asked, right? Only about half of the time, so 52% of the time, the risk-reward relationship was discussed, which is abysmally low. You might say, well, it's half the time. Yes, but that's terrible, which means about 47% of advisors didn't bother telling people that investments that have a higher potential for return also have typically significantly higher risks involved. You should always discuss risk when you're dealing with investing. Now, investment goals. So the investment goals of the clients were discussed 89% of the time, so that's pretty good. complete collection of know your client info was only done 32% of the time, whereas incomplete was 68% of the time. So what does this mean? Know your client information is literally a set number of questions, which are very similar to the questionnaires that I've covered in two previous live streams when we were talking about portfolio balancing. And basically how to use some of those online questionnaires to figure out how much risk tolerance you have. So again, I've had some of these in the past, so check back with that. I'll have future videos covering this. So ideally, that should be one of the first things. Basically, if your advisor, if a potential advisor doesn't bother going through the questions to figure out what you actually need, and collecting, so what type of information shows up on a Know Your Client form typically? Well, the type of information that would show up there would be things such as, what is your current salary? Do you have any debt? What are your short, medium, and long-term goals? Do you want to buy a house? Do you want to have children? How secure is your current income level? Do you want to start investing more as you're earning more money from, you're getting promotions, etc.? Or are you, or you just want to sporadically, whenever you have money, invest once in a while? Or do you want from every single paycheck, do you want to transfer over $1,000 from every paycheck, or $1, or whatever it is, right? All those things matter. Do you want to retire when you're 45 or when you're 65 or never? You would set up a retirement account or an investment account for retirement very differently if the retirement is supposed to happen at 45 versus 65, right? Again, if you plan on having children, do you plan on investing in RESP for them? And on and on and on and on, right? So a Know Your Client form, and especially a complete one, when you're collecting that information, that's what key information there is. So an advisor that does that automatically without you having to ask them questions and volunteer the information is usually a sign of a good advisor, right? Communication, so plain language was used 68% of the time, which is not too bad, but let's face it, you don't want an advisor that treats you as a child and dumbs everything down to the point where they're explaining the everything 5 times over. But at the same time, you want someone who's able to express themselves in a way that you understand, instead of using advanced terms that are never defined and that kind of lose you halfway through, right? And again, fees were discussed 56% of the time, which again is a bit troubling, because that means, almost half the time, how much you're going to be paying in fees, what fees are involved, were not discussed. And then compensation, in terms of how the advisor himself or herself is discussed, was only disclosed 25% of the time. Obviously, if you ask the question, they have to tell you. But again, clearly, a lot of them are very uncomfortable, making it making it transparent that by having you as a client, by suggesting certain investments, they earn a certain percentage on that, right? So an industry that is open and transparent should not have this low rate of voluntary disclosure about these things. And I know it's not polite to ask people how much money they're making. I'm not asking you to ask them exactly how much money they made yesterday, right? Or how much money they're making per year. But ask them, what is the relative percentage of the money that they're managing in your account that they're going to be charging you? And also, are they being paid via salary or commission, or a combination of both of them, or is it an hourly rate? So you understand what you're paying for and what services you're getting, right? All right, so just to wrap up, when should you get an advisor? Well, when you have more than $100,000. If you have less than $100,000, probably sticking to something like a robo-advisor is advisable in most cases, right? Now, there are some very competent advisors out there, but there's also some bad ones. Again, and that's not coming from me. That's the report I just mentioned to you. Again, that's our the last link there that I just mentioned to you now. And that was conducted by the 3 large regulators in Canada. No conspiracies, no far out, person telling you that, you should invest with them and don't trust any other advisor. No, it's literally the regulators of the various segments of that industry that came up with this. Okay. Again, read the report, at least the executive summary, those 3-4 pages of the executive summary. And there's a lot more than, I just touched on kind of some of the main findings, but there's a lot more slightly troubling information in there. And make sure to ask the questions and get the answers to those key questions that I mentioned before when you're interviewing a potential advisor to become your advisor. All right. So once you have $100,000 or more, again, in some cases, depending on the services that you want, you might need at least $250,000 for them to be willing to accept you as a client. But yeah. So make sure you get the answers to those questions. And again, those questions, I did mention those 5, 6, I think 7 questions that I listed over there, but there are more of them. And again, quite a few are listed here. Again, you can see this is from this is one of the other regulators. Literally, these guys kind of keep track of the various registrations and designations of each person, right? So that's another regulator, yet again, telling you should be asking these questions. So check if the advisor and firm are right for you. Ask these questions. So are you and your firm registered, right, with a regulator, i.e. with them, the Canadian Securities administrators, basically? What is your education and professional experience? What types of investments are you registered to sell? As I mentioned before, different advisors, different certifications give you different permissions to sell different things or advise on different products. How long has your firm and branch been in business? Again, you probably want to stay away from tiny startups. Not that they're wrong. It's just that you lower your chances of being a victim of a scam or having issues. Also, incredibly important, make sure that the company they work with is also part of the CIPF. We've covered this in previous sessions. That's why I didn't include this here. So that's the Canadian Investor Protection Fund. Okay, so here you go. So does the CIPF guarantee the value of your investment? So what is CIPF? So any company that is a member of CIPF, and you can click on the member directory right here. I'll include this link when I update the description. Again, I haven't included it because I've included in at least 2 other previous sessions that I've done. Some may not still be online, but yeah. So this is literally the list of all financial institutions in Canada and advising institutions, financial advisor institutions that are licensed to, that are part of the CIPF. So if an institution is a member of CIPF, right, what that means for you, and obviously the big guys are here, right? BMO is here. TD is here, CIBC is here, but also some of the smaller ones, right? If you're looking at things like, online brokerages, for example, right? So Questrade, for example, is listed there, okay? RBC, obviously, large bank, TD, obviously, no surprise there, I think, right? So they're listed here, Merrill Lynch, et cetera, et cetera, et cetera. So if they're a member of CIPF, what does it do? Well, let's zoom in so you can see it. So does CIPF guarantee your investment? No, your investment is not guaranteed. If your investments drop in value, CIPF is not going to be refunding you. And by the way, CIPF is a Canadian, that stands for the Canadian Investor Protection Fund, and it's basically a crown corporation of the federal government, of the federal Canadian government. So they're not protecting your money. However, right, if you're investing with a firm that goes bankrupt, for whatever reason they go bankrupt, whether they're a large firm or a small firm or a big bank or a small bank, as long as they're a member of CIPF and as long as your investments are covered within that, up to $1 million per investor is covered by CIPF for their membership, for any member institution. And what happens at that point in time is the company goes bankrupt, then the underlying investments that you had get sold, get liquidated. And then whatever the value of the investments, up to $1 million will be refunded in your account. So if the market tanks, you're not going to see a single penny from CIPF. If your investment firm goes under, however, you will get your money back. So this is why it's incredibly important to make sure that whenever it is that you're investing with a firm that is actually part of CIPF. All right. So I'll include the member directory for CIPF here in the list as soon as I'm done with the live stream. All right. There we go. So yeah, how long have they been in business? How long have you been with the firm? If I have a concern with how my investments have been handled, what is the process of addressing that? So if you're uneasy, you see that the investments haven't performed as well as you have, is there someone you can contact? Or should you contact the advisor directly, etc.? What's your firm dispute resolution policy? So if there's a dispute between you and your advisor, how are you paid for services, salary, commission, or flat fee? again, every single regulator tells you that this is an okay question. Not only that is this an okay question, but this is a question you should be asking, right? How will you help me reach my goals? How often will I receive account information from you? Is it once a month? Is it once a year? How often will you review my portfolio? So when will they be rebalancing it, if at all? Will you be my main point of contact, or will there be somebody else, a secretary or an associate or a trainee or something like that? Why do you think you are a good match for me? Literally ask them. This is almost like, the where do you see yourself in, or tell me about yourself, a question in an interview, right? And so, can you tell me about other clients who are like me and how you help them reach their goals? This is not essential. If they're telling you, well, you're the first one, doesn't necessarily mean that you should walk away from that advisor. It's just that the more that advisor is familiar with individuals that might share similarities with you in terms of where they are in their life, stages of their life, and so on and so forth, the more likely they are to be familiar with things and anticipate things that you might be looking for or needing. All right. So literally, it's recommended that you fill out one of these for every advisor that you see. And I would say, visit at least 3 to 5 advisors before picking one. And again, until you have $100,000, or in some cases, until you have $250,000, you're probably best served, for most people, just go with a balanced, diversified portfolio of ETFs managed by one of the many a robo-advisor out there. Or if you're a bit more savvy when it comes to investing, you can try to create your own balanced, diversified portfolio. You can watch other videos. I'll put them. I'll put an end card at the end of this, and you can watch those relevant videos that I've already done, live streams that I've done here. So that's pretty much it for today. If anyone that is currently watching this has any questions, I'll maybe give you 30 seconds or so to ask any questions you might have. And then, that's, as I said, we're sticking to the 1 hour limit. Today, there's not that much to cover. Okay, I'm waiting because, again, there's usually about a 20-second delay between YouTube and me talking. So I just want to actually wait to see if there's any questions. Again, I don't seem to see any of them. If you have any questions and that come up afterwards, literally just leave a comment down below, and I'll be very happy and very glad to answer your questions. So you don't have to be here in the live stream to be able to ask me questions. So any questions you might have, just type it in the comment section at that point. Well, all right, since I don't see any questions coming in right now, I will be ending that here for today. So one more time, thank you so much for your time, and see you at the future session at some point or another. Take care and have a great day, everybody.